Well, good afternoon, everybody. Welcome to our 2020 Economic Outlook Luncheon. My name is Tim Sink. I'm president of the Chamber. Thank you very much for being here today. I would like to start off by thanking our sponsor, Eversource Energy Services. Eversource has been a tremendous supporter throughout the state for economic development for a very long time, and they've been a good friend of the Chambers, so we're grateful for their support, and please join me in showing appreciation to Eversource. Just a couple of quick announcements, things coming up on the 14th of this month. We have a business after hours, which is right here at the Holiday Inn at 5:30. If you are a young professional or you know young professionals, we have our monthly Concord Young Professional Network meeting at 43 Degrees North on the 15th of this month. Our legal breakfast series continues at Orrin Reno on the 22nd of this month. That's at 8 o'clock at the offices of Orrin Reno. It'll be a legislative briefing from some of their top attorneys. And I want to mention that we have a legislative outlook that is scheduled for the 30th of this month. Keep your eyes peeled for information. That'll be coming out shortly. And finally, we've scheduled our annual State of the State with Governor Sununu, and that is a luncheon on the 13th of February. So all this information is on our calendar. We have a couple of city councilors with us today. I want to recognize Byron Champlin and Linda Kennison. Thank you so much for joining us. We're right back here. Also have a great showing of Chamber board members. Joe Casper is our immediate past chair, and I'm going to ask all board members to stand up and be recognized, please. You too, Mr. Havner. Thank you. And finally, wanted to mention we have a guest with us today. Ben Briley is the British Consulate General from the Boston office. He's here today with us. He is meeting with officials at the city and Economic Development Director Susie Pegg. So welcome, Consul General. Glad to have you here. We are so pleased to have Jeff Fuhrer back with us to give this economic outlook. It's a treat. He's been kind enough to join us a number of years, so not a stranger to many in this room. Just very grateful for you, Jeff. I do understand that he's retiring in the not-too-distant future, so I'm not sure what we're going to do next year. A little nervous about that. But we do have him today, so we're grateful for that. And just a little bit of background, Jeff is the Executive Vice President and Senior Policy Advisor at the Federal Reserve Bank in Boston. In 1992, he joined the bank's research department as an Assistant Vice President and economist. And from 1995 to 2001, he headed its Open Economy Macro International section. He was named Senior Vice President and Monetary Policy Advisor in 2000 and became Director of Research in 2006. And he was named Executive Vice President. Jeff began his career at the Board of Governors of the Federal Reserve System, and he started there as a research assistant, and after earning his doctorate, returned in 1985 as a senior economist. He has served as an associate editor for the American Economic Review. He's published numerous papers, scholarly papers, on the interactions among monetary policy, inflation, consumer spending, and asset prices. He has earned degrees from both Princeton University and a PhD of economics from Harvard University. He knows his stuff, and we're so grateful to have you here, Jeff, so thank you.
So it's true, this is probably the last time I will speak to you as a Federal Reserve employee. I started there in 1979. That is more than 40 years ago now. I've been with the Fed altogether 37 years, 4 years off for bad behavior in graduate school. So it's great to be here. It's great to have friends in the audience, folks I know and have met with before. I'm going to talk about a couple of different things today. So one is just what's going on with the economy. One is, very briefly, some challenges that the Fed will face over the next 5 to 10 years, and this is actually true for most central banks around the world. And then the third thing I'm going to touch on briefly is to preview, while the overall economy is doing pretty nicely, there are a bunch of folks in the economy, and by a bunch I mean tens of millions, who are not doing as well at all, and it's really important for us to recognize that, but also to take that on as a challenge for the next 25 years so that we don't look back 25 years from now and say, nothing really changed, sorry about that. That would be a colossal failure, not just in terms of economic potential, but in terms of lost human potential. So I'll come to that in a moment. There's some striking data that I want to be quick. First, you have to see that animation again. That is just so much fun. So this is my disclaimer. My views are my own. They don't reflect this guy. Do you know who that guy is? Oh, yeah. Okay. So say it. Yes, it's Jerome J. Powell. He's the chair of the Fed, right? They also don't reflect the views of this guy. Do you know who that is? Well, you know it, but you're a ringer. Kathy is a ringer here. So, so I'll label them now. Those are my boss's boss and my boss. I don't speak for them, although generally they agree with most of what I say. So here's the deal. It's about two economies in part. So I want to give you a quick update. It's not going to take long on the overall economy. I want to talk, as I said, a little bit about some high-level issues that are challenges for monetary policymakers, and I'll tell you why that is. And then talk about what lies beneath the aggregate numbers. Now, I actually went back to look when I spoke with you last year ago or whenever that was. This is what was going on about a year ago. These are stock market indexes at the time. So as you can see, the markets, starting in October of 2018, were down going into 2019. The Fed wasn't sure how to proceed. It looked kind of bad. And then this is what happened to the market after that. It improved quite nicely, right? We've had a significant improvement in market valuations for all of these major indices over the last year. So why did that happen? Well, for one thing, the Fed lowered interest rates. You may recall that about a year ago, a little more than a year ago, the Fed was poised to raise interest rates further. Not to restrain the economy, but in their view to get back to something that was roughly neutral, policy that wasn't spurring the economy, wasn't constraining it either. But they changed their mind, and they lowered interest rates 3 times this year by a total of 0.75 percentage point. That actually helps. That's why we do it. Consumers kept spending not just because of the decline in interest rates, but consumers have been actually quite resilient throughout this entire recovery. And then there was some, and I emphasize some, resolution of uncertainty about trade policy, and I'll come back to that in a second. So it ended up better than we thought it might around a year ago. Let me show you some of the signs of the underlying strength and resilience in the economy. First, from the labor market, this is showing you 2 lines, green and magenta. Just have to note, I want you to pay attention right now to this right here. This is the name tag, which is falling off. And what I want to point out is that although we can invent quantum computing, we cannot invent a sticker that does the one thing it's supposed to, which is stick to your clothing. Why is that? I would suggest there's a market opportunity there for someone. These things always fall off whenever I put them on my clothing. So anyway, so there's the 2 lines there. The green line is showing you what the average number of jobs created in the economy were over the last 3 months, average per month. So a little over 200,000 jobs per month created over the last 3 months. That's a pretty healthy clip. How do you gauge what's healthy? Well, when the economy's doing just fine and is at full employment, we need to create something like 100, maybe 110,000 jobs a month just to provide employment for the folks who are entering the labor force as they come of age, finish education, whatever. So at 200,000, we're doing more than that, and then correspondingly, the result is that the unemployment rate, which is I'll call that magenta line. What do you think of that? I don't do colors that much. Magenta, what did you say? Magenta, we're getting a second on that motion. So the magenta line has been going down, is now at 3.5%, which is as low as it's been since a couple of months ago. But prior to that, you know when it was last at 3.5%? Anybody? This is a little quiz. I will give you a door prize.
69.
What are you? Okay, so 1969. That's correct.
Door prize?
Yeah, I've got a little piece of cheesecake right there on the table for you. That is yours. Okay, so that's all doing nice. That's just to say the labor market is still quite resilient. This is as of the November data. We'll get December data tomorrow. I don't get to see that in advance, so I can't tell you what it's going to be, but it's probably going to be okay. Going without wage growth, which had not been growing earlier in this recovery, has actually picked up some. It's growing between 3 and 3.5%. I'm going to talk a little bit more about whether that's an okay number or a not so okay number in a second, but it's not, I'll tell you at the moment, it's not bad. Okay, so employment is growing, wages are growing, that's providing income growth for households. The other thing that's doing well for households is that their wealth is high. So the yellowish line in here is the ratio of household wealth to their income. It's about as high as it's ever been. Interestingly, normally when their wealth is high, you can kind of see this in the chart. When wealth is high, households don't feel as much of a need to save because they've got wealth, they've got money in the bank. That's typically the case. However, today they're saving at a pretty high rate, and that's likely a hangover from the Great Recession and financial crisis, when a lot of people felt as if maybe they could have had more savings on hand. That might have been a good idea. They did not. Now they do. But in any event, the fact that they have high wealth and also are saving at a pretty high rate means there's probably some room to continue spending without dipping into their savings much. They could lower their flow savings rate a bit and consume a bit more. So just to say, the underpinnings, the income, the employment, the wealth, all look good for consumer spending as of today. So don't expect that to fall apart. There are mixed signals from two other key sectors. I'll just talk about the purchases of capital equipment and housing, new housing construction. So with respect to capital equipment, so that line is showing you the difference between orders and shipments for new capital goods. So why do I show you that? Because orders are things that will happen with capital goods in the future. Right? You order them now, they come a few months from now. Shipments are things that are coming in the door right now. When orders are in excess of shipments, it means shipments are probably going to rise, because that's what you do. You order. You guys do this online now. There's this company, it's called Amazon. They do a fair amount of business. You order stuff from them, and then it comes later as a shipment. The lag time here is a little bit greater, a few months or something. But that's the notion, is that when the orders are above the shipments, it means it portends an improvement in shipments. But that's actually been the opposite of late. Orders been, on average, below shipments. That's why they're below the zero line there. So just to say capital equipment, kind of, not great. I'm going to talk about why that is in a moment. And then housing, I'm showing you the permits for single-family homes in most states and locations. It's a good idea to take out a permit before you build a house, otherwise someone will arrest you. So it's a good leading indicator of actual construction, and that actually has been doing pretty well, in part because mortgage rates today are lower than they were 6 to 8 months ago, and of course that's because the Fed lowered interest rates. So here you can applaud for the Fed. No, you can actually. You can actually applaud. So I made you do that. Okay, right? So that's because mortgage rates are lower, and that's partly because of us. Okay, but there are risks, one of which is trade policy. That has both direct effects, as you know. There are probably more than you might think about. Of course, what happens when tariffs are imposed is the price of imported goods goes up relative to relative to domestic goods. That's true. There are other effects as well, the most important of which is that the supply chain for pretty much anything that's made in the U.S. around the world is incredibly complicated and, of course, crosses national boundaries. So when you change the prices of things going across the borders, the supply chain needs to readjust, and that is not a trivial process. And so, most importantly, when companies don't know for how long those tariffs are going to last, they don't know how large an adjustment and for how long they need to make adjustments to their supply chain. That uncertainty means they're not making all of the investments in capital equipment, which I just showed you a moment ago. That's one of the reasons, and we can quantify this a bit more carefully than I'm doing at the moment. But it is the case that uncertainty about trade policy seems to feed into investment, and it's somewhat subdued as a consequence. Here's a measure of trade policy uncertainty, the red line. I won't go into how it's constructed at the moment. Just trust me, that's what it's doing. And you can see that over the summer, it was as high as it's been in a long time. That's not surprising. There were things that were up in the air. Folks didn't know where it was going to go. The good news is, while it's not back down to normal, it's come down quite a bit in the most recent couple of months. So maybe that's somewhat good. This is what I said. Some trade policy uncertainty has been resolved. There's still some things that need to happen, but some has been resolved, and we hope that'll help the economy. The other risk to the economy comes from abroad. A lot of our key trading partners are not growing as fast as we are. In fact, most of them are not. That's true for almost the entire euro area. It's true for Japan. And the UK will, I know they're going to do Brexit by January 31st. That's what Mr. Johnson said. So that's going to happen. Exactly how that works and what the transition looks like, we'll see. There'll probably be some upheaval from that. But in any event, just to say the folks who buy our exports, that's our trading partners, not doing as well as we. And so that's going to exert a bit of a drag. And there's some risk there because we don't know exactly how that's going to proceed. All right. So the bottom line then on the outlook is just that it looks okay. These bars show you what people are forecasting for growth this year, just now last year, and the current year, 2020, as they went through the year 2019. And you can see it actually improved a little bit, both for last year and for this year. It turns out it is somewhat easier to forecast the past than the future. So I'm more confident in forecasting 2019 than 2020, although not all the data is actually in yet for 2019. But it looks like 2019 is going to be an okay year, probably 2.2, 2.3% growth. Not bad. Something a little bit slower than that they expect for 2020. But not so bad. So good. That's a good thing. Labor market's probably going to stay tight. The unemployment rate's not going to go up much from where it is, as best we can tell. And policy has supported that. That's what the easing was about. That's what the interest rate cuts were about earlier this year. So that's that. I just want to touch briefly on a couple of big picture issues for the Fed. So this is something you don't have to think about all the time, but you're going to think about right now with me. And that is that we're in an environment in which interest rates, on average, no matter what's going on, are going to be pretty low. There are reasons for that I won't get into, but just you can see if you look around whenever you go to borrow now and compare it to 10 or 20 or 30 years ago, interest rates are low. There's no question. So what does that mean? It's a challenge for the Fed. It's also a challenge for central banks around the developing economies. The way we typically respond to recessions or weakness in the economy is by lowering interest rates. When the average level of interest rates is quite low, other things equal, it gives us less space to move interest rates down to offset the weakness. Now, that isn't the first thing you would think about, but it's one of the first things we think about because that's how we try to keep the economy on a stable footing. So we're going to think about what else can we do other than lowering interest rates if that's the case. And then I want to come back to this issue about wage growth and whether it's really a sign that the economy is fairly robust as we think, and as most anecdotes would suggest. Talk to anybody about whether it's easy to find labor, and they'll say, well, no. So let's think about that. So first on low interest rates. Remember that the interest rate you pay, I know you know this because in Econ 101 they taught you this. It has two pieces to it. One is the compensation for inflation. You would never put money in the bank and hope to get back less than the rate of inflation because you'd be getting back, dollars that wouldn't buy as much as when you put the money in the bank. That would be bad. So at least want the interest rate to pay you for inflation, and then probably some more because it's an investment. That's the real part. Okay, so real rates today seem to be quite low. There are reasons for that. Demographic composition of the economies. We are an aging population. The productivity rate is also, growth rate is also low. Both of those things would tend to make real rates lower. So on average, nominal rates are going to be low, and so this is a picture of that problem. So what does this show you? This shows you what the Fed has tended to do in the last 8 recessions since 1960. They lowered interest rates, that's what the chart is showing you, on average in the red line by a bit more than 5 percentage points. That's what they tend to do, is lower rates, and this tells you about by how much to offset a recession. Of course, some recessions are worse than others. Sometimes we move them more, sometimes less, and so on, but that is the average. Today, the federal funds rate is set at a rate between 1.5 and 1.75 percentage points. It's supposed to be in that range somewhere, and it is. Which means that if a recession hit tomorrow, which it won't, that I can probably predict. A recession will not hit tomorrow, barring an enormous geopolitical disruption. And what could possibly go wrong geopolitically, really? So, anyway, it probably won't happen tomorrow. We would have, as of tomorrow, 1.5 to 1.75 percentage points by which we could lower the interest rate. But the average is more like 5, which is just to say we don't have the kind of ammunition we would normally have to combat a recession. That's what that chart is about. We call it less policy space, but it's just mean, we don't have as much room to lower rates. Okay, so what do we do about that? Well, I don't know. Over the long run, one thing we could do is raise the average rate of inflation. I know that seems really counterintuitive, but if we did that, on average, interest rates would be higher, and then we'd have more room to lower them. Now, that would probably take a little time, and it is not on the table at this time. The chair of the Fed, whose picture you saw earlier, has said we're not thinking about raising the inflation goal, which is currently, thank you, 2%. You can't answer all the questions, but anyway, between you and Kathy, it's just going to be like a back and forth there. But so it is 2%. He said we're not going to do that at this point, but we will think about some other things. I'm not going to get into these in detail, but one thing you might do is suppose you're in a recession and the inflation rate's 1%. You know your target is 2%. You could promise to be a little bit above 2% somewhere in the future temporarily. Why would that matter? Well, two reasons. One is, this is the extra credit answer. It would lower the real rate of interest rate. That's the rate of interest adjusted for inflation, really subtract inflation. So if inflation's higher, real interest rate's lower. So that might work. But the other thing it really means is you're really promising just to keep monetary policy stimulative for longer, because that's how you would get inflation to be above 2% somewhere in the future. If people believe that today, they might feel better about the economy. They might be more likely to go spend. I think you should feel somewhat suspicious of this story because it involves expectations and people's deeper understanding of how the economy works, but it is discussed. So that's one way. The other is we can just use some of the tools we have apart from just moving that short-term interest rate. We could use those more aggressively. So we did a bunch of quantitative easing, which was just buying treasury securities, mostly long-term treasury securities, with the goal of lowering long-term interest rates. We had lowered short-term rates as much as we could. What do you do? Well, let's try to lower long-term interest rates directly. We purchased securities. That's going to lower their interest rates. We could just be more aggressive about that. The problem is that the Treasury market is big, and our balance sheet when we bought those Treasury securities went from about $850 billion, which is pretty big. That's more than I make in a week, actually, I just calculated. That is true, not informative, but true. To just about $4.5 trillion. That's a huge balance sheet. There are some complications with having a balance sheet that large, but in any event, if it's a bad recession, we might be able to do that. We might use this promising stuff in the future. We could actually cap long-term rates, not just purchase them, but say, look, we're in the market. We're going to purchase as many as it takes to keep long-term rates from ever going, say, above 1%. We could do that. How many purchases it would take, I'm not quite sure. So there'd be uncertainty about how big our balance sheet would get, how many securities we'd have to buy. But we could do something like that. A limitation there is that, when we started the Great Recession, long-term interest rates were like 4.5%. Today they're 2%. So there isn't as much room to move them down either. But those are some things we could do. I think an important lesson from thinking about all of this is that there's only so much that monetary policy can do. We've done a lot of it. We might do a little bit more in the future. It's probably not going to solve all of our problems. So there's another side to policy. There's monetary policy, and then there's fiscal policy, that is tax and spending policy at the federal and local level. And it may be that they will need to help out when the time comes. I know that's not always popular because it would mean a temporary increase in deficit if you increase spending or cut taxes. But then again, a temporary increase in the deficit may be better than a permanent one, which is what happens if you leave the economy in the toilet forever. So that's the trade-off you might make there. Okay, great. You know what? I don't know what my time is, Tim.
You're good.
I'm good?
You are.
And I'm not even paid to be good, so that means I'm good for nothing. I learned that joke when I was like 12, and it still works. Okay. Well, then I'll tell you about this because it's simple. It's just to say there's definitely concern, there was earlier and there still is today, about whether we shouldn't be seeing more in the way of wage growth. And as I said, and you can see in the chart, it's somewhere between 3 and 3.5%. This is an amalgam of various measures. How often do you get to say amalgam in public? Hardly ever. So I got to use that word too. Another advantage today. So anyway, but the question is, well, is 3 or 3.5%, is that a lot or a little? So again, you have to have some way of calibrating what a healthy rate of wage growth is in economies that change over time. So the way we think about this is, well, sort of like the interest rate arithmetic I talked about just a moment ago. If your rate of pay is going up less than the rate of inflation, that's a bad thing because you're losing every year. All the stuff you need to buy is getting more expensive more quickly than your wages are going up. So you should at least get the rate of inflation. But also every year, workers on average are contributing to the efficiency, the increased efficiency with which the economy makes stuff. That's what's called productivity growth, right? Every hour they work, they make more stuff per hour this year than they did last year. That's a fact. Today, that increase is about 1% per year. That doesn't seem enormous, but it adds up over time. So you would think that on average in the economy, workers might have wages going up at the sum of inflation and productivity growth. Those are the two things I just described. Those numbers today would add to about 3%, maybe a bit less, but around 3%. Wages are growing a little bit faster than that because labor markets are probably a little bit tight. Is that okay? We can debate that, but it's not completely out of the realm of reasonable. That makes sense given what's going on with inflation and productivity growth. I'll talk in a moment about folks who are not keeping up with inflation or productivity growth, and that, to me, is a much larger concern. So we'll come back to that in a second. It really is just about a second. Okay, so now that's the aggregate economy. What I want to talk about now is what lies beneath the surface of that, what seems to be otherwise a fairly robust, still resilient aggregate economy. That's the story for the aggregate today. What lies beneath it is different. And it's important, and as I say, I think it's actually one of the top two challenges that the country faces over the next 25 years. So one is what's going on with people who are not succeeding in the economy. What do you think the other one might be? Sorry? No. No. That's a challenge, but it's not one of the top two. Any other ideas what might be a top challenge facing the country for the next 25 years over the long horizon? Demographics is, yeah. That's actually the one. So demographics are a part of the background for sure. We know pretty much what they're doing, and we do need to adjust to them. They're partly responsible for the low interest rate environment today. But climate change is a big thing. I'm not saying that as a political statement. I'm saying as an economic statement. It is going to make a big difference to what we can do, where, and for how much cost. And we're not really adjusting to it tremendously at the moment, let alone trying to slow it down much. So that's an issue. This one is at least as big, I would say. So let me show you a picture of, in the aggregate, over a long span of time. This goes back to World War II. What happens to earnings for laborers, for people who work in the economy, that's the blue line, adjusted for inflation, relative to productivity growth? So I just told you that their earnings should equal inflation plus productivity growth, or their earnings adjusted for inflation should grow at roughly the rate of productivity. And what's interesting is up until the 1970 or so, they did. And then after 1970, they didn't. Right, that line is flatter, so it means they're growing slower. Earnings, on average, growing slower in the economy, adjusted for inflation, slower than the productivity gains that labor is contributing to production. Okay, so that's interesting. Another way of looking at some of this is we've had GDP growth, which comes in part from increases in productivity. And the chart on the right, which you'll have to take home, maybe take to your next cocktail party to amuse and delight you seem suspicious of that. I don't know why. You show them this chart and explain to them that the GDP growth we've had over the last 50 years, which is significant, has accrued mostly to the upper income deciles, not so much to the lower income deciles. Disproportionately high for the upper income deciles, especially the top 1 to 10%. Similar to what's being said in the left-hand chart. Okay, so where did all that income go? The GDP is the sum of all the income generated in the economy when we sell stuff and produce it. Where did it all go? Well, it went to profits, right? If it didn't go to the folks who were working, it went to the people who own the means of production, as Karl Marx used to say. Any of you still reading Karl Marx? He's still pretty popular, I guess. I don't know. You don't want it to go to his head, but he's still pretty popular. Anyway, if it's not going to the workers, it must be going to the profits, and the national accounts show that that is the case. So the profit share is high. It's down a little bit from its all-time historical peak, but it's still higher than it was in most any other era. And the red line, which shows the share of income that goes to labor when things are produced, has been going down over the same period. So that's an interesting phenomenon. That's interesting. Maybe the bottom line from this is that in the aggregate, the economy is doing well. We have a good amount of aggregate wealth and income. However, the distribution is not great for people in the lower income deciles. Okay, so how does this happen? that there are folks who don't get a large share of the economic pie, even though in the aggregate we're doing pretty well. It's an affluent economy, but there are a lot of not affluent and many poor folks living in it. How does that happen? Well, there are a bunch of contributing factors. Here's one that I think is startling. It's about the fact that where you're born determines a huge amount of what your economic outcomes are. And by where you're born, what I mean is, so just because we're here, these are some census tracts in Concord, New Hampshire. And what it shows you is that depending on which census tract within Concord, New Hampshire you were born, 30 years later, the median household income you can expect to earn differs by a factor of 2. That's the median. There are larger differences than that and some smaller ones, but the median is a factor of 2, from 24 to 53. That's more than 2. 27 to 53 is slightly less than 2. You can do the arithmetic and check. It's true. But so this is for this is in those census tracts. We actually track individuals, and by we I mean it's the Opportunity Atlas, some researchers from Harvard and Brown universities. They track individuals from their birth in this particular census tract. They look in particular at folks who are white males and their children born to low-income parents, so stratified in that way. And then they look at them 30 years later and see what their household income is, and they take the median of all those folks. And that's how they get this data. So this is pretty hard data, right? Tracking real individuals, real outcomes over time. Why is it that in the same city, less than 1 mile apart, let's say loosely, the average household income 30 years later should be so different based on where you were born, right? And it's not like all the engineers grew up in one neighborhood and all the doctors grew up in another. I mean, you can't explain it with that. But the fact is, where you're born has a profound influence on your economic outcomes. And so if you went to Mobile, Alabama, the same thing is true. It's just that the entire scale shifts down. There are neighborhoods in Mobile, Alabama, where depending on which neighborhood you're, some blocks away from some other neighborhood, your household income 30 years later will be twice what it was in the income, partway across town. However, the top there is 30,000 rather than 53,000, which tells you about Alabama, not the best place to be born. So what's fascinating about this to me is that we live in a country that calls itself the land of opportunity, which in some ways it is, and certainly the aspiration is there. But in reality, it's not opportunity, it's luck. No child chooses, I think this is a theorem, it's an axiom maybe, a theorem. No child chooses where he or she is born. I think that's true. The kids don't have any say in it, but 30 years later, their economic outcomes depend critically on where they are born in a fairly micro sense. Okay, I don't think that's a good thing. I think we need to think about why that is, but it is one of the determinants to the differences in incomes is just the accident of birth. And you can add to that not just the geographic location, of course, but also the characteristics of the parents to whom you are born. Income matters, so does educational aspirations, so does stability of the home, stability of employment, all those things. They all contribute in a way to kids' outcomes by things that the kids have absolutely no choice over. So I think we should fix that. I would be remiss if I didn't mention the racial component to these disparities as well. The Boston Fed did a study in conjunction with some partners to look at what wealth looks like in families from different demographic backgrounds. So this table shows you can read, or I'll say, the median net worth of a family as a percentage of the median net worth of white households in the Boston metro area. If you are a U.S.-born black family, your net worth is, as best we can tell, approximately 0% of a white household. That is, you don't have any net worth. You may have some assets, but your debt at least equals your assets. So net worth for U.S. blacks. Caribbean blacks are doing much, much better. They have 4.8% of the average net worth of a white family, and you can see the other categories: Puerto Rican, Dominican, other Hispanic, and so on. Now, the important part of the research that goes with this, those are the facts as of just a couple of years ago. The other part of the research is figuring out, why is that? Why is net worth so different? And here's what it's not due to. Income, education, all these are good things, right? I'm not saying that. But you cannot explain that large a disparity by the difference in income levels or the difference in education levels. If you standardize on education or income levels, you explain a very small fraction of the difference. Correspondingly, if you do some arithmetic, if you equalized income levels for white and non-white households today, it would take roughly 75 years for net worth levels to catch up. That's a long time, and that assumes that the white households are not improving in terms of net worth, which they probably will be. So what is responsible for the gap? It's not those things. So here's the sad fact. It's intergenerational, and it is largely caused by government policies. And I don't say that as a kind of a loose inference. What I mean is, if you examine the legal record, I can give you a book that goes through this in gory, excruciating, and depressing detail. Most every public policy that had a wealth-building implication since the Civil War was explicitly tilted away from people of color in the United States and towards white families. The GI Bill, unemployment insurance, housing assistance, I mean, it just goes on and on. All of those things, you can see the written record where senators are explicitly designing the programs so that they will not be available to folks who are not white. It's amazing to me that that's true, and it's depressing to read this book, but the documentation on that is very thorough, and it's not drawing inferences, it's just what the senators and so on said at the time, and then look at how so for example, unemployment insurance, when it first came out, excluded domestic and agricultural workers. Well, at the time unemployment insurance came out, one of the most common occupations for African Americans was domestic work or agriculture, and those were explicitly excluded from the bill. Why? Because there were some often Southern senators who said, well, we can't have that benefit going to those people. Okay. You should read the book. I will refer, there are actually several books about this. The research is sad and compelling. Over generations, we've denied those families the opportunity to build wealth in a way that allows them to pass it on to subsequent generations. Whereas on the other hand, white families, through educational, housing, GI Bill, unemployment insurance, all those things, have been able to build wealth in much larger numbers, that much larger. That's an interesting and sad fact that we need to come to grips with when we think about the differences in wealth disparities. Fortunately, we are making inroads into differences in income and education. That is closing. The gap is not closed by any measure, but it is closing, so that's good. The wealth gap is not, and the facts behind it are critical. So what do we do? Those are just a couple of interesting, I say interesting euphemistically, interesting facts. What do we do about that? So there are things we can do. The Fed has been working on a variety of projects, sometimes with partners in this state and all of the other New England states. They are based on some important principles. One, whatever you do, you should start with research and data. I don't say that as a full employment act for economists. I say that because the only way to know whether something is actually having the effect that you intend is to collect data and also to do research. Collecting data is not sufficient. And by research, I mean you do work that allows you to disentangle the many causal influences that are at work in any economic geography so that you can see what part of good fortunes is due to the economic intervention that you may have designed. Okay? There's really no other way to do that unless you have some very fortuitous natural experiment that just lets you see exactly what you did showing up directly in individuals. That doesn't happen very often. So apart from that, you need research and you need data. So you start by basing it in there, but of course that's not sufficient. You need to, so when I say maintain a learning orientation, what I mean is if we knew exactly how to solve all these problems, it might be, although I'm not sure, but it might be that they'd be solved already. The fact is we don't know. And one of those most important things to learn when you try something and do the research and evaluation to determine its efficacy is to find out that something is not working. That's really valuable information because if it's not working, you know what you should do? You should stop doing it, right? If you keep doing the same thing over and over again and expecting it to be different this time, that's the definition of being a New York Mets fan. So, or insanity, perhaps. But in any event, that is valuable information. So that's a learning orientation. You keep trying, you look at it, you evaluate. If it's not working, good. That's good information. Go somewhere else. Okay. The other thing that's really important we have found, and this is research-based, we looked at a bunch of cities around the country to see which ones had succeeded and why, and there are a number of things. But one of them is that the only way to address most problems in urban and rural settings is to build a collaborative of folks across all of the major sectors who are aligned and trying to solve a common set of issues, hopefully one at a time. Why is that? Because there isn't anything that goes on in economies that are complicated like Concord or Manchester or Nashua or Lawrence or Lowell or New Bedford. But there's nothing that is simple and that is not intertwined. That is, if you want to think about how to make workers succeed in your economy, it isn't just about wages, it isn't just about benefits, it isn't just about work scheduling, it isn't just about health care, it isn't just about child care, it isn't just about transportation, and it isn't just about affordable housing, it's about all of those. Some people to more and to greater and lesser extent, but all of those things interact in ways that are really important. So if you want to think about making workers ready to come to work, I think I left education out of there, which is ridiculous, but out of that list of 7, I should have added an 8th, which is education. If you want to make progress making workers ready to do the jobs that are going to be available in this economy, all of those things have to be addressed. That implies that it's going to be a cross-sectoral collaboration that needs to look at that. Importantly, part of that collaborative, it's not just the state or the municipal government or the nonprofit sector or the private sector. It's not just them. It's also the residents of those areas, because they know something about the way life works that I don't. And their input into the identification of problems, the design of solutions, and the seeing through of implementation is critical. So that kind of collaborative thing is another principle that's really important for addressing. And we have examples where that has worked in specific locations for specific problems, showing population level improvements. Great. This should be obvious, but it's not always. Economic development is easiest to motivate when it's about building a building or renovating a downtown or beautifying a park or something like that. It's tangible. In many cases, it has an actual financial return, tenants paying rents and so on. That by itself doesn't actually necessarily mean anything for economic development, because in the end, economic development is about improving the human capital and the labor force participation of people. It's about the people. So there's nothing wrong with building and with beautifying and with revitalizing, as long as you all know and design in a part of the process whereby you expect and track to see if it actually happens, that people in that location are benefiting. The people in lower income and middle income strata are benefiting from whatever building and so on you're doing, because if not, who cares? All you did was locate nice activity from one place to another. Some business decided to locate here. Some white males who were going to work in Bedford, Mass. Come to work in Bedford, New Hampshire, and that doesn't really matter. It's nice for the local area, but it doesn't really denote economic development. So these are some examples of things that are going on in the Fed. The Working Cities and now Working Communities Challenge is in 5 out of 6 states. There's one state where it's not happening yet. Yes, it's New Hampshire, not for lack of trying. We are trying hard. There are actually a bunch of other people in New Hampshire who are trying hard as well. We're not quite there yet on getting full cooperation across all of the aforementioned sectors. I'll leave it at that. Okay, but it does work, and it espouses those principles and puts them in place. And we have a staff there who are incredibly good at working with that, what was initially ill-defined, not done before in the Fed, process, and making it come to life and make a difference. And you can talk to the people who live in those cities. They will tell you what's working there. The other thing we're working on is improving low-quality jobs. And when I rattled off before the characteristics that have to do with successful workplace experiences, that's what this is focused on, is trying to understand how it is that our economy that is otherwise quite successful has arrived at an equilibrium whereby a large swath of jobs pay enough wages, don't pay enough wages for you to eat at night, so you have to get food stamps to survive. You're working, and that's not made up. I'm in the business of using actual facts and statistics. I don't make stuff up. There are other people who do that for a living. That's not what we do at the Fed. These are actual facts, right? Folks who are working, their annual income, the median income of the working folks in the lowest 20th percentiles is around $15,000 annual income. You can't possibly afford housing and food and maybe transportation, let alone health care and educational enrichment. So you can't afford that stuff. So the fact that we're in an equilibrium where folks pay at a rate that means that you have to be on food stamps and get other means of government support in order to survive is an interesting outcome. Why we are there is something we need to think much harder about. So we are. Okay, one final perspective here is that often when people hear anyone talk about programs to help families in poverty or in low to low moderate income situations, they say, you're just talking about redistributing income, taking it away from wealthy people like me. And you know, I'm not wealthy, but I feel like I'm pretty darn well off these days. We do fine. But I'm not actually talking about taking money away from people like me and just giving it to other folks. That's not what this is about. This is about changing the economic system so that the overall size of the pie gets larger for everyone. Why does that happen? It happens because when you bring more individuals into the economy by improving their human capital at first, and then they add to human capital as they work and gain experience, they are adding income that gets spent on stuff to the economy. The whole economy is getting larger. It isn't about redistributing. It's about making the pie bigger. It's about bringing more people into the economy. And as I said earlier, it's about allowing people to live to their full economic potential as well as their full human potential. Both of those matter to me. One last thing I'll say, and then I need to stop, I think, right? Because I'm probably, am I at time more?
We have a little bit of time for Q&A. That would be
Okay, I will have this. So this is the last thing I'll say. An important part of this 25-year project, and it will take at least that long, is changing the narrative or the narratives that people carry about what goes on in families that are living in poverty. Because we often don't live with folks in poverty, because most of the people in this room, I won't speak for everyone, I wouldn't presume, but most of the people in this room don't live in abject poverty, and they don't live in neighborhoods next to people who are in poverty, and so they don't know those people, and so they're free to write their own stories about why those folks are poor. One of the most common stories is that poor people are poor because they don't work as hard as me. I am successful, me, Jeff, tall white male, because I worked really hard. And that is true to some extent, but to an even larger extent, as I showed in some of the earlier charts, it's due to the luck of where I was born, to which parents in which location, with which set of expectations and which sets of supports that allowed me to succeed over time. The notion that the folks who are poor, if they only worked harder, would not be poor is actually embarrassing if you know people who are poor. It's embarrassing to say that. I've just decided to market a bumper sticker that says this: laziness is uniformly distributed across income deciles. and you know, I haven't tested that, so that's the one thing I made up. But I'll bet you anything it's true. I know it's true. I have seen lazy people across income deciles. There are people who are insanely rich who are lazy. They fell into something, they were lucky. There are also incredibly rich people who work really hard, of course. And there are people in the middle who span the spectrum. It isn't laziness that explains differences in economic outcomes. It's a lot of other things that we need to work on. It's the way our system works to make it relatively easy for people like me to succeed. It's not that I didn't work hard, I worked really hard. But that is not sufficient to succeed in our economy. If it were, we'd have much more successful people. So that was the last thing, and then I'm going to stop there, and maybe we have a little time for Q&A. That would be great.
Curious, to what extent do you think that the gap between productivity gains and earnings is tied to the shift in executive compensation towards stock options, towards stock value and stock options? I don't know how that timing.
Yeah, it's an interesting question. So there's a guy named Milton Friedman. So most of you know, famous economist. He was partly responsible for the notion that the main goal of companies is to improve shareholder value. That's sort of their organizing principle. If they keep doing that with every decision they make, the company's going to be successful. So that, I think, is partly responsible. This is more hypothesis at this stage. There's some work on it, but it's that exclusive focus on shareholder value, which also shows up in compensation for executives, is partly responsible for the workplace norms that we've developed, whereby it's okay if you send some of your workers home on government assistance. Because that's an artifact of saying, well, if I have to satisfy shareholder value, I will do as much as I can to increase productivity and innovate. But the other thing I can do is cut costs, because that increases profits, and profits are exactly what drives shareholder value. Well, of course, the most time-honored way of keeping costs down is keeping labor costs down, because labor cost is still roughly 2/3 of all costs in everything we do. So there is something there. I worry a little bit less about, honestly, about how much executives are paid per se. I don't understand it, and I think it's a little bit wacky. I think the median is about 350 times median non-CEO earnings is what CEOs earn. That's a little hard to justify, I think. But I'm less worried about that than I am about the absolute low level of earnings and benefits and work conditions for people in the lower strata of the economy. Yep. I don't know who's first, sorry.
Two quick questions. One, what's the name of the book?
The name of the book is White Rage. It's by, which is not a great title for a white audience, mostly, I'll say. But, you know, we can live with it. It's Carol Anderson is the author, White Rage. And she's a legal scholar. It has many, many footnotes. And it just goes through. It's
the other question is getting back to your early slide about employment. And we read that the employment figures that is commonly bandied about does not include those who have stopped seeking employment, and but it does include those who are holding more than one job to make up the statistics. So can you address that, please?
Sure. So that one statistic, that's the civilian unemployment rate, or as we, what's the right word for this? Anyway, we call it U3. What a great name for a statistic. It's U3. That is the share of the labor force that was either working or actively, well, that was not working but was actively looking for a job in the survey week in question. That's how they capture the unemployed. That's at 3.5%. We at the Fed and other places look at a whole raft of other statistics about labor market health, including how many are multiple job holders, which, you know, that has changed during their session. One of the most important ones during their session was the number of workers working part-time for economic reasons. They wanted to work more, but they couldn't because of the state of the economy. That was quite elevated for a while. That goes into a broader measure of labor market health that we love to call U6. Here's U3, 4, 5, 6. Anyway,
There was 7, but go ahead.
There's no 7. No, but you might want to invent U7. But we followed that, and actually Eric spoke about that several times earlier during this expansion when the part-time for economic reasons was elevated. Fortunately, that has come down quite a bit. And again, overall, even those sorts of indicators that are broader indicators of labor market health, those have all improved with the long expansion that we've had. So,
Thank you.
you're sure.
There was a story on NPR this morning about what role recent increases in minimum wage, some 24 states have done, and what role that has played in this wage growth number that you're looking at. And I'm wondering if you have any thoughts or comments on
I
that.
don't have too much more beyond the NPR story. So it is true that in the wage increases, I guess the good news is that some of the wage increases, many of the wage increases have been concentrated more in lower paid jobs, and part of that has come from the increases in the minimum wage. You know, maybe that's a good thing. The traditional concern among policy analysts is that when you raise the minimum wage, two things happen. One is you raise the wage of people who are employed, but the other is you may make employment expensive enough that some people lose their jobs. And that is a huge literature that has not reached super firm conclusions, but actually one of my good friends from graduate school is one of the world's experts on analyzing the minimum wage impacts, and what he says is, so some of the studies that say that their unemployment effects are not done too carefully. There are probably some employment effects, but on that it is probably a benefit. I don't, as a Fed employee, I don't want to get into the political argument of whether minimum wages are good or bad or whatever. The argument I do want to get into is that as an economic system, as I said before, we need to get to a place where the lower level of wages is enough that people don't need to use government support to literally stay alive. So that's where I would put that.
I was more interested in what
But you want to know
part
what?
of the wage
Yeah, as I said,
has been caused by
So-
increases in the minimum wage.
So there's a study on the Boston Fed website from a couple years ago that shows the fraction of individuals who are making wages of $15 an hour or less, and that number is around 30%. So that's true. That's true for most. There's some variation in the states in New England. That's approximately true in other states around the country. So you could say a quarter to a little less than a third of folks might be affected by. I mean, that depends on which industry they're in and so on. So that would account for some of the wage increase. I don't have off the top of my head a quick number, but yes, some of it comes from that. It's not the only place that wages are rising, for sure. Yep, sir.
Do you agree with the statement that negative interest rates is a failed policy experiment?
I'll say that it's unlikely to be pursued by the Fed anytime soon. There are folks who believe it actually had a positive impact in the countries in Europe, Japan, where it was pursued. We have a fairly different financial structure, and that matters for what the impacts of negative interest rates would be. So you can see the minutes from the last FOMC meeting where they actually said something about negative interest rates, and that was, I think the best answer here is never say never, because if you get in a really, really bad crisis and you have nothing else, you might try that. But it is not high on their list of things, partly because their assessment hasn't been as successful as you might have liked, and it will be even more complicated given the financial system in the U.S. Yep, that was the same question. Do you want to ask it again? Okay. Anything else? Yeah.
Thank you for the talk today. Could you speak to the drug issue? We've had a serious drug issue in the state here. Many other states have experienced it. But in terms of how that feeds into data analysis, even
Sure.
if that's considered, because I think we can all say that it has affected in a negative way productivity,
Yeah.
let alone healthcare costs and impacts on families.
So just as a disclaimer, I'm not an expert in opioid use or in opioid treatment or policy. But what I do know is that one of the interesting puzzles during the recovery is that a swath of prime-age males who had been employed prior were not, and they're not enjoying the success in the labor market that some others were. And when folks looked into that in some detail, it looks as if a sizable chunk of them are on painkillers, are experiencing pain. You know, I don't think we have super good data on that, but suggests that, you know, a sizable chunk of the folks who didn't come back to participate in the labor force, it was because they were having an opioid issue or some other drug addiction issue. Big enough to notice. That has improved recently. More prime-age males are coming back in. I don't know if the breakdown shows that it's folks who have gone through opioid addiction recovery or not. I don't think we have national data on that that I know of. But it's a factor. And you know, the data are just not hard enough to say a really hard number for that. But it's a factor, and it's big enough to notice. Yep.
Thank you. In your data analysis, do you figure in tax policies?
Yeah. Do you want anything more specific? Because yes, we do. Now, so in order for us to think about what's appropriate monetary policy, we need to make a read on where the economy is going. Part of that is what is the stance and what are any changes in tax policy, because those, we believe, have effects on the economy, some smaller, some larger. So we have hundreds of economists around the system who go out and estimate the effects of tax changes on real spending and saving and so on. And that feeds into our outlook for the economy. No question?
Time for one more.
Yeah, there was a question over here. Yeah. Yep. Yeah, universal basic income. Yeah. I've read about it. I wouldn't say I've done, you know, like econometric modeling or anything, but I've read about it. So two things that are important in my mind. One is, if what people mean by universal basic income is let's figure out a way to dismantle the safety net. No, so let's not do that. Because you know, as you can see from the data, the folks in the lower income deciles, they are clearly, they have to use pieces of the safety net. Thank God it's there. So you don't want that to be dismantled. The other parts of the universal basic income are, if it's motivated by the concern that automation will put people out of work, so why don't we just pay them for not working? that's missing a really good opportunity, which is if you think they're not going to be able to work because automation will require more education, we should educate people better rather than just paying them UBI. On a personal level, I think people actually are motivated to do something of value in the economy that they feel is contributing. I think I'm not a psychologist, so I don't know, but my personal observation is that matters to people. They want to get up and do something they feel like they're contributing to something of value. That's what work is. I think that's partly built into us. Taking that away and giving UBI would have interesting effects. I'm not sure how that would go. But so it's not actually my first proposal. My first proposals would have to do more with building human capital for people to make them equipped to do the work that will be around in the next 10, 20, 30 years, rather than saying, oh my gosh, robots are coming. What are we going to do? Let's just pay everybody money and they'll go buy stuff. That's probably a little too flippant a response to that proposal, but it doesn't strike me as the first thing we should be doing. I think it's Andrew Yang has a UBI type proposal, right? Yep. Okay. Thank you.
Jeff, that was really terrific. I really like the message that you brought to the table this time. That very much appreciated. So thank you so much for being here with us again. I want to thank Eversource again. We can't do these programs without generous support of our sponsors, and Eversource has stepped up to the plate a number of times for this event, and Connor Jennings is with us here today representing that organization. So thank you, Connor. And thank you all for being here, and we will see you at an upcoming chamber event.